Okay, everybody, let's get started on this Facebook Live. I want to thank the DLP team for being here to share in this presentation. On the upper left, we have Don Wenner. He is the CEO of Dlp Capital Partners. And we also have Rich Delgado here. You can see him on the lower left. I'm on the lower right, obviously. We're going to be having a good presentation here. First, we're going to have Don present some slides, tell us a little bit more about DLP and their investment offerings. And then we're going to have time for questions and answers. So as you go along, you can ask your questions. The easiest way to do it is just to type them directly below where you see the picture here, just as a comment on the Facebook post. And we'll take those questions and we'll get them all answered at the end. So anything you think of or you come up with during the presentation, go ahead and start typing them in, and we'll have Don and Rich get those questions answered as we go along. All right, so for now, I'm going to pull myself and Rich off the screen and let Don present some information about DLP.
All right, awesome. Well, thank you, Jim. Appreciate that very much. And as Jim said, I'm going to share a little bit of information about DLP. I'm going to start off in presenting and sharing a little bit of information about us as a manager, and then get into our strategies and the investment offerings themselves. And the way I think about making an investment is there's two things that really matter. You need good management, and that's whether you're investing in a public company or a private investment fund or in real estate. Whoever's responsible for the investment, you need a good manager, and you need a strong strategy, a strategy that makes sense over the life of your expected investment. So I'm going to explain why we're a great manager, or why we're the best manager to choose if you're interested in investing in real estate, equity, or lending, credit. And then I'll explain the strategies and what makes them unique, and how we work with investors, how we structure our funds themselves, and the underlying investments we make. So without further ado, I will get us started here. So that building you see there on the screen is our St. Augustine, Florida office. That's actually where I'm talking to you from right now. Dlp Capital Partners is a private investment group designed to produce consistent double-digit high-yield returns while providing liquidity and no losses to investors. We do that by investing in workforce housing as an owner and as a lender, which I'll describe more as we move forward. A little bit about myself. As Jim said, I'm the founder and CEO here at DLP. I started the organization in 2006, so this is actually now year 15. Over that period of time, I've closed more than 16,000 real estate transactions, well over $4 billion, including the acquisition of more than $2 billion worth of real estate and the lending on more than $2 billion backed by real estate. Currently, with our investors and our funds here, own over 11,000 rental homes, multifamily and single family homes. Won a lot of awards for the growth and the organization that we've built here at DLP. One of those awards that I'm most proud of, and I think is most indicative of who we are and how we structure our investments, and why I think you'll be impressed when you see our investment returns and how we go about earning those returns, is the consistency to which we have grown the organization. And we are one of the 5,000 fastest growing companies in America here, according to Inc. 5000, for 8 straight years. And Inc. 5000 judges or grades the fastest growing companies based on your growth over a 3-year period of time. So over our now 14 plus year history, we've grown on average every 3 years between 300 and 500%. You could choose any 3-year period over the last 15 years, and we've grown between 300 to 500%. We've grown over 60% every single year for 15 years. We are the 4th fastest growing company in America out of any companies that have made the Inc. 5000 list 5 or more times, and this is our 8th year in a row. So that consistency to how we've grown the organization will bear in our investment funds, and the consistency we've been able to generate to our investors. Maybe more important than everything I just told you, at least more important to me, I am the father of 2 little boys. You'll see there on the picture on the screen, Donnie, who is 8, going to be 9 in a couple weeks, and Alex, who is 7, and my wife Carla. We just celebrated our 10-year anniversary. Actually renewed our vows on the beach for our 10-year anniversary a couple months ago. And I'm also proud head coach of football and basketball, and now officially today, I guess I'm a coach of our soccer team I was just signed up for. So that's where I spend some of my time outside of growing our organizations here with our great team, which I'll share in a moment. These are the DLP companies. So DLP Real Estate Capital, which you'll see on the left-hand side here of the screen, is our parent company. But at the top of the screen, you'll see Dlp Capital Partners, which is our investment fund management company. That's really the engine behind everything we do at DLP. So in short, investors such as yourself invest alongside of us into our funds, and then we deploy that capital either through our lending company, Dlp Lending, providing loans to other real estate operators, or directly acquiring real estate, workforce housing, and then managing those assets, including property management, construction management, asset management through DLP Real Estate Management. We also have a real estate brokerage title company. We do our own loan servicing, et cetera. Some of the other companies you see that support our investment strategies. This gives you an idea of us by size today. We have over 1,100 investors such as yourselves invested with us in our funds actively today. We have over 600 loans in the lending side of our business. We own over 11,000 homes in our equity side of our business. We have over $1.2 billion in AUM. We do over $100 million a year in revenue. And most importantly, we're providing housing to more than 25,000 residents right now and actively and quickly growing. We're providing capital funding to more than 200 real estate operators, entrepreneurs who are in turn improving real estate, producing and creating workforce housing, creating jobs, improving communities. And we have over 400 full-time employees, or we call team members, here in the DLP companies. So that's a little bit about us, and I'll happily jump in any other questions about us. And you can also, as you do your due diligence on us, we'll send you a lot of information you can dig into. Also, you can go to our main website, dlprealestate.com, and learn about our purpose, our core values, our mission, our team, our culture, and understand what makes us unique and why we have been able to generate really great consistent returns to our investors, which I'll show you now. I'm going to walk you through our current investment funds that we offer, and I'm going to start with the equity side of our business, or the ownership side of the business, meaning this is the fund that invests in acquiring, improving, and managing, in short, workforce housing. This is our 8th fund we've done over the past decade. This is our largest fund. It's now our flagship fund. It's a $1 billion evergreen REIT, private REIT. So evergreen meaning we're going to keep this fund open and continue to grow it as long as it makes sense to do so. Meaning we expect to be running this fund a decade from now, 2 decades from now. It's a private REIT, which in short just means that it's very, very tax efficient, which I'll talk more about in a moment. So some of the highlights of the fund, again, it's evergreen. Right now, the fund owns over $500 million worth of housing, over 5,400 rental homes, multifamily predominantly. The fund produces annual valuation. So we analyze the value of the assets every year and produce an updated valuation that we're actually finishing up 2020's valuation right now. Along with the annual valuations, we actually provide you with annual redemptions. And what that means is that even though this is an evergreen fund that will likely be running 2 decades from now, as I mentioned before, you don't have to come into this fund and commit for 2 decades. You don't have to commit for a decade. You don't have to commit like most real estate funds for 5 to 10 years. You only have to commit for a year or less, meaning every year, beginning of every year, we provide investors with annual redemption option. So no matter when you come in this year into the fund, you'll have the ability beginning of next year to redeem out of the fund in part or in whole if you so choose. Another tremendous benefit, and one of the biggest reasons as you look at the different options I'm going to present here now, why you would potentially choose this fund, is the tax efficiency. This is our most efficient fund from a taxable standpoint, and arguably the most efficient place you can invest your money in terms of most tax efficient. So this fund has all the benefits of investing directly in real estate of depreciation, which allows us to offset most, if not all, of our operating income from tax, defer that gain through depreciation. But what makes this fund even more efficient is the fact that it's an evergreen structure. And being an evergreen fund, we are able to, as we sell property, so if we bought a property today and in 3 years, 4 years, 5 years, we turn around and sell that asset, instead of us having to distribute out long-term capital gains to all of our investors, we're able to do a 1031 like kind exchange. and we're able to defer out those gains, and we're able to do that again and again, and really defer out any taxable event, essentially indefinitely, and while allowing you as an investor to choose when you want to exit the fund, and in effect, being able to choose when you're going to have a taxable event based on what makes the best sense for you. And the third reason this fund is really, really tax efficient is the REIT tax election, which provides unlimited qualified business income deduction, which basically means any of the income that we do derive from operating income that isn't already deferred from tax through depreciation will also have a 20% deduction to what your tax rate is, your marginal tax rate. There's unlimited qualified business income because it's a REIT election. That might be too much information over the head of some, and if anybody has more questions on that, we can dive even deeper. But all that's to say that the fund is extremely tax efficient. Another benefit of the fund here is DLP, the fact that we're an experienced, vertically integrated fund manager. This is not our first fund. It's not our first equity fund. It's not our first value add workforce housing fund. In fact, it's our fourth workforce housing equity fund that we've done over the past decade. And we've drastically exceeded the return targets here of this fund in all of our previous funds as well, which we'll talk about. Another benefit, even though this is a real estate fund that's evergreen and you have the ability to stay in as long as you'd like, you're still able to generate monthly income. So we pay out monthly distributions each and every month in this fund. You have the option of reinvesting those distributions every month or taking the distributions. The monthly distribution target is our preferred return, which is 6%. So we have a 6% preferred return, which is paid out at 0.5% dividend a month, 6% a year, 0.5% every month. You get as a monthly distribution if you so choose. That actually gets paid out on the first or sooner of every single month. And that 6% preferred return that we pay out to all of our investors is a preferred return, meaning that you earn 6% return before we earn any profits. But we actually take it a step further. And I promise if you were to go out and look at 100 different funds, whether they're real estate funds or hedge funds or private equity funds, you would be hard pressed to find another investment fund where the manager not only has a preferred return where they defer their profits to a preferred return, but where they actually don't earn even a management fee. So we subordinate our management fee to the preferred return. So it actually goes a 6% preferred return to investors. Then we get our management fee, and then we split the profits above that 6%, 80-20, 80 to you, 20% to us. The fund has a 12% annual return target, annual returns net to you, net of our management fee and our share of the profits. And we do quarterly reporting on the fund, annual valuations, annual liquidity. We have a great CPA firm auditor, Cohen Resnick, who does our audits for the funds and also manages our annual valuations. And then we have a great law firm, Stuart Kissel, who's our SEC counsel for the fund as well. And what the fund owns is predominantly workforce housing communities. Some people call it Class B or value add multifamily are terms people use. Those are all good terms for it. But what I like to think about is it's workforce housing. Workforce housing that is affordable for the local workforce. And that is a major, incredible crisis we have in America today of housing that's affordable to the local workforce. Our average rent across our portfolio is less than $900 a month. There is a tremendous demand for $900 a month rentals throughout the United States, and certainly throughout where we do most of our investing, which is throughout the Sun Belt, largely in secondary and tertiary markets throughout the Sun Belt, where there's strong population growth, strong job growth, and tremendous demand for affordable housing. And there's no new product being built in virtually any market that's certainly under $900 a month or that's anywhere near affordable for that local workforce. And that's a big deal. It's something we take a lot of pride in. And we look at all of our investment funds, and certainly the housing fund, are impact investments. We are dramatically impacting this crisis of workforce housing throughout our portfolio. And that's a tremendous focus of ours, is keeping our communities, as much as we focus on maximizing our returns, getting fair rents, minimizing our expenses, doing physical improvements to improve the safety and the condition and the attractiveness of our communities. We're also focused on keeping our rents affordable, which allows us to make an impact on this demand for affordable housing, but it also allows us to attract really great residents and then keep them in our communities, lowering our turnover costs, lowering our maintenance costs, et cetera. So that's the DLP Housing Fund. That's the side where we're owning the real estate. Again, this fund owns about 5,500 apartments. Likely by the end of this year, 5,500 apartments and homes. We'll own around 10,000 rental homes by the end of 2021. So the other side of our business is where we transition from being a owner of the real estate to being a lender to other real estate operators similar to DLP. And we've been running this side of our business, our lending strategy here for the past now going on 7 years. The Dlp Lending Fund is our main lending fund. It's our largest lending fund, which we'll touch on each of them. It's a $500 million evergreen REIT. So I described what evergreen and REITs were, explain the housing fund, same thing here. We have distributed double-digit returns every single month for the past nearly 7 years. In fact, we've generated over an 11% annual return every single month for the past nearly 7 years in this fund. In addition to generating great double-digit returns, this fund is very liquid. You can redeem out of this fund with just 90-day notice. So no long-term commitments. You can redeem out at any time for any reason. And this fund is not as tax efficient as the housing fund, but it is more tax efficient than most private investments in that we get the benefit of also being a REIT and getting the unlimited qualified business income deduction, which means you get a 20% reduction in your marginal tax bracket. So some highlights of this fund. It has a 10% preferred return, which means you earn 10% before we earn anything again, even before we earn our 1% management fee. You get a 10% return, then we get our management fee, and then we have an 80-20 split. We distribute out twice a month in this fund. We pay you out the 10% preferred return on the first of every month. And then around the middle of the month, when we close out the books, we pay out all earnings above the 10% return and what we call EDC, excess distributable cash, around the middle of every month. So 2 distributions a month. But just like the housing fund, you can choose to let those investments reinvest and compound every single month. If you're not looking for income, you can change at any time, completely flexible. And our lending fund, just like our housing fund and each of our investment opportunities, you can invest qualified and non-qualified money. This fund is also audited by Cohen Resnick. This fund also has the same legal counsel as Seward Kissel. This is a $500 million fund. Other point I'll mention here, for all of the white coat investors, we have lowered our minimum investment to $100,000. So it's not $250,000 or $500,000 that you'll see in the fund docs. That's the minimum for any other investor. But for white coat, we've reduced our minimum down to $100,000. So that is our DLP Lending Fund. Those are our 2 largest funds. Here's our historical track record to the lending fund. You'll see 13.49% is what we've distributed net to investors over our history. Here are the annual returns shown each month, what the returns are shown in an annual format. So you'll notice here in 2020, once COVID hit, we stayed over 11% returns, very, very consistent ever since COVID, as we've had less leverage and more cash on hand. Prior to COVID, we've actually always been above 12%, but we've stayed above an 11% return net to investors all through COVID. Another important point worth mentioning here in our lending strategy is we are now on month 10 since the start of COVID as we look at it, and we have not had one single default or forbearance agreement on any of our 600 plus loans. So we've had perfect performance by our borrowers as we are lending to full-time professional real estate operators. On average, our borrower who we're lending to, who personally guarantees the loan, has over a 700 credit score, has over $3.5 million in net worth, has over $500,000 of liquidity, has completed more than 50 real estate deals. And on average, we're only lending 55% loan to value. So you'll see why those are some of the big reasons why we've had such great performance throughout this entire COVID environment, and why we're continuing to perform the way we always have, even through very volatile times here, even in the depths of the early days of April, May of the COVID timeframe. So in addition to lending fund, we have another similar fund we call the DLP Income and Growth Fund. This is a fund that generally we have actually not been marketing, but we're making available here to you as white coat investors. We've had a number white co-investors come to and say, hey, I've saw and heard about this other income and growth fund, which is actually getting returns a little bit better than the lending fund. Why can't I invest in this fund? And we just had been kind of simplifying it and only taking capital of recent into the lending fund. But we have our income and growth fund, which is a very similar fund, a little smaller, about half the current size, but extremely similar to the lending fund in terms of what we do. Fundamentally, it does the same thing the lending fund does, short-term bridge loans backed by real estate. This fund has slightly outperformed the lending fund, has the same 10% preferred return, the same 10% return target, but has always generated over an 11% return in every period. And historically has been over 12%. And in 2020 outperformed the lending fund by, I believe, about 0.5%. So great opportunity. There's a couple of small nuanced differences between the lending fund and income and growth fund. I can either get into in questions or we can talk with you on one-on-one, but another great opportunity. And for some investors, they like to get a little bit of diversification in terms of the return and just putting some money in each fund. We have a lot of investors in both funds, and there's a few reasons why that could make sense for you and worth exploring, worth looking at doing, especially considering, again, the income and growth fund has been generating a little bit higher returns than lending fund, and we're expecting that to continue. And here's the historical returns over the years. So last year we were at 11.96 was the annualized return in 2020. And last but not least, we have our DLP Positive Note Fund. So this fund also invests in the same lending strategy, making these short-term loans backed by real estate to successful full-time operators. The difference here in the Positive Note Fund is instead of you being a limited partner in the fund, you're a lender to the fund. So instead of you sharing in the partnership profits, you're getting a fixed return on your investment. So the great thing about investing as a positive note investor is you know exactly how much you're going to earn because you're locking in on a fixed interest rate. You can choose to commit just for 90 days, meaning you do a note that at any time you can redeem with 90-day notice. Or you can commit longer if you'd like and lock in a higher rate for a longer period of time. You can lock in for 1 year, 3 year, 5 year. And then based on how much you invest and how long you choose to commit, you get this fixed return. These returns are showed assuming you're going to take distributions every single month. If you're not looking for income, you can let it reinvest, and then you'll get the benefit of compounded returns. This is the lowest incremental risk. This is the lowest risk of any of our funds incrementally, in my belief, as I believe confidently. We've never lost $1 for any investor. We've never even missed a preferred return. We've never missed a fund return target. But our note holders are fixed return investors. We are signing an agreement, a contract, a note agreement, guaranteeing you to pay you this fixed return, guaranteed by us, not by the FDIC. So this is an obligation of ours. Regardless of our profitability, we're obligated to pay these returns. So you have incrementally an even lower risk profile. So it'd be a great way to get started, great way to lock in and get a fixed return on your investment. It'd be a great way to kind of start our relationship. And that's how many start with us here in our Positive Note Fund. So with that said, we're going to open it up here to questions. But after this meeting and after the questions, you can reach out to myself, Rich, Bo, Larry, or if you're already working with any of our other, we call investor success managers, Bob and Brett and Mike, any of our team members would love the opportunity to chat with you. And you can also go to dlpinvest.com. You see there on the screen. And there we can either register for you or you can go and do it right now on your own in 30 seconds. You can create an account and you'll get access to our actual financials, our balance sheets, our income statements, our actual assets, our loan tapes, our monthly reporting, our audits, the fund documents, everything and anything you could want to see to learn more about each of our fund offerings. So with that said, Jim, I'm going to open it up here, start tackling questions.
Thank you very much for that presentation. We'll pull us all back up on screen here. Just as a reminder, in your upper left, we have Don Wenner. He's the CEO of DLP. And now on the right, we have Rich Delgado. He is the managing director at DLP. We've got a number of questions here. I'm not sure that you've been able to see those questions. Have you, Rich?
I have not.
I'm seeing them through the public chat, so I've been taking them down. So if you'd like, I can start going through them right now. I got a bunch of questions on the housing fund and a few others that have come through, and I'll just welcome the group to keep asking those in the chat box, and we'll keep putting them through for either Don or Jim. So let them rip, and I'll go first on the housing fund. The big questions are around the geographical locations and how many states are you in, and do you have to file returns for all the different states? Investors are concerned about their tax filings, and then we'll get into sort of talking a little bit about the the K1 and how it's all reported.
Great. So that was a couple questions there. So I'll start with, so we own today, all said and done, the housing fund owns about half of our whole portfolio. Virtually all of the communities we're buying here as we move forward are all going in the housing fund. But some of our more legacy assets are before the housing fund existed. So in our whole portfolio, we're in 21 states. The housing fund, I don't know off the top of my head, but I would guess is in 13 or 14 states at the moment. But we'll likely be in 20, 21, 22 states here in the months ahead. We're predominantly throughout the Sun Belt. We're predominantly in the secondary and tertiary markets throughout the Sun Belt. In terms of taxes, so we do a composite return on our end. You will not need to file in each state, only in your home domicile state. And then I guess I'll just go ahead and do it. We do issue K1 statements in the housing fund. There's a chance eventually we may be able to convert to doing 1099 statements instead, but right now we produce K1 statements.
I just lost Don there.
Yeah,
Let's see if we can get him back in here.
Yeah, let's try to get him back in, and I'll continue to answer the question while Don gets back on. But we do issue a K1 at the end of the year, and then following on that, right, we had a lot of questions from the group around how depreciation is passed through, and does it get passed through, and then how the fund gets valued. So we'll go ahead and ask Don that question. It seems like he's back. So Don, thank you. We got the answer on the K1. So next, going into again the fund, how is it valued? How does one's investment grow, if at all? And then how can one tell how much equity investors have total in the fund? So 3 different questions there, all coming through.
Sure. So we value the fund on an annual basis. We go and get third-party independent valuations done on each and every asset in the fund. And then those independent valuations run through Cohen Resnick's valuation department to do a final reconciliation of the values. And then that provides a consolidated fund level value. So that happens March of each year that the updated value goes out. And how it actually works mechanically to you as an investor is, assuming, let's say for 2020, our values went up, and this, we don't know the final numbers yet as we're waiting for them to finally come back. But let's say it ends up being a 7% increase in the value of the underlying assets. And what will actually happen is we'll distribute to you as an investor an additional 7% of what your current balance is in terms of additional shares. So you'll own, now if you owned 100 shares today, after we do our valuation increase, you'd own 107 shares. And you'd have the option to take liquidity if you wanted to, or just let it grow. And now the next year you're getting your 12% return target and your 6% monthly returns based on your increased number of shares. You're getting a compounded value as the fund grows. In terms of knowing what the total equity is of the fund and of all investors, we provide to you in our investor portal, which is what I was referencing earlier, dlpinvest.com. You can see the actual balance sheets and income statements of the fund every quarter. So we make that completely transparent to you.
Excellent. Thank you very much. And then in the same vein, there are a lot of questions around depreciation, how is that handled, and when are capital gains realized?
Yeah, great question. So depreciation in short, we're able to depreciate out roughly 3 to 4% of the value of our assets every year. And when you use, and we do use, for those more sophisticated, we do use cost segregation studies and get into more, I'll use the term aggressive ways of making sure we're maximizing our depreciation benefit. But generally, with using a modest amount of leverage, we can earn about a 10% cash on cash return annually just from operating income, and defer all of that gain from taxes. So with modest amount of leverage is basically how the math works out. So it works out really well. I mean, if we drastically perform above a 10% cash on cash return, there may be some taxable gain that depreciation does not offset, but that's a good problem to have. And then in terms of when we pay capital gains, so most assets, if not all assets, as we sell them, the intention is that we do 1031 exchanges, which means all the gains from the sale of the property we're selling get rolled into a new property we're buying, and it's not a taxable event. So when you as an investor would have a taxable event would be when you choose to redeem out of the fund and cash out. Now you'll have a capital event at that point in time.
Excellent. Thank you very much. So moving on, again, there's some general questions around the fund itself. And first, many of them coming in are around qualified accounts, and can we transfer in 401ks, IRAs, and then more specifically, what are the advantages and disadvantages of investing with a qualified account, and which is best for, say, a self-directed IRA?
Yeah, great question. So all of our funds you can use, qualified and non-qualified. You can use regular IRAs that you have with, say, a Charles Schwab or a Fidelity. You can use self-directed IRAs, as Rich just said. You can use old 401k programs. Pretty much any type of retirement account. There's a lot of different nuanced ones for certain industries, such as a couple of the different teacher programs. So yes, pretty much any form of private retirement account. We even manage a number of money in private 401k, active private 401k programs for various employers, including some doctors, and potentially if you have a 401k that you're a participant in a larger company, potentially depending on the rules, we could even have you allocate from an active 401k that you're just a participant in. So in short, yes, we can handle qualified and unqualified funds. In terms of what makes the best sense, so what we find a lot of investors choose to do is they put their qualified money in our lending strategy, whether that be the lending fund or the income and growth fund or the positive note fund, because now they're earning these strong, in the lending fund income and growth case, you're earning these strong double-digit distributions deferred from tax. So now you're getting these great current yields in a tax sheltered environment. And a lot of people then put their unqualified money or non-qualified money in our housing fund, because now that they're getting this great tax structure, this very efficient tax investment in a normally a non-tax efficient structure, because you're not in a qualified account. But we have some people certainly who say, look, even though a lot of my money is in my retirement accounts, I'm still going to put those retirement accounts in the housing fund, because regardless of tax, the housing fund is still expected to have the overall highest returns. So you say, regardless of tax, it's still going to have the highest returns. A lot of people still choose that for their qualified money, especially when they're looking at, longer term investment. They're, planning to work for another, 10 years or more. Hey, I want to get the biggest growth over the next decade plus. So I want to put that money in the housing fund, even though it's already tax efficient. So, but when people have both qualified and non-qualified money, generally kind of thinking is non-qualified money goes in our lending strategy and qualified money goes in our lending strategy, non-qualified goes into the housing fund.
Excellent, Don. So again, going back to the valuation, we're getting some questions in around how to determine on an annual basis if there's been a gain or loss in the fund, since we've had a couple of investors look at financials and say, we're not able to see the cost basis. So can you walk the investors through how we value and how we reset that value every year?
Sure. Yeah. So there's kind of three components to the value that we generate throughout the year. So one is the operating income that we generate, the income, our rent we collect minus our operating expenses, that remaining cash flow, that net operating income before we pay our debt service, that's operating income. So that's the first form of income. And that's what drives and generates the majority, if not all, of the 6% return we're paying out on a monthly basis. The other two forms of ways that we generate and create value are through realized and unrealized gains from the increase in value of the property. So if we sell an asset, we now have a realized sale, even though from a taxable standpoint, we're doing a 1031 exchange and we're not having a taxable event. From a financial standpoint, from a business standpoint, we are, if we bought something for $10 and we sell it for $12, minus of course all the transactional costs, we made $2, right? That profit is a realized gain, not taxable, but it's a realized increase, because we now have $12 to invest in the next property instead of 10 that we started with. So we have the realized gains that come from the sale of assets. And then lastly, we have the unrealized gains of us increasing the value of the properties, increasing the value through better management, through physical construction and improvements, through general appreciation. So we go and we actually get third-party appraisers to go and value that property each year. So let's say, again, say we bought a property, we invested $20 million into a property between purchase. So we bought it for $20 million, we put $2 million into improvements, and we have $23 million total investments with closing costs, improvements, and purchase. And we get an appraisal on it for $27 million. That's a $4 million increase over what we invested. So we do that at every single property and come up with a value of each asset. They combine the value of all the assets, our cash, et cetera, into the overall value, the overall balance sheet of the fund. And that's where we generate the valuation of what each share is. So we take that updated value divided by our number of shares and tells us, what our increase is. And I get into some of the more technical components. For us, each share is $1,000 a unit. And so if unit values go up, we actually, as I mentioned earlier, we actually distribute to you more shares. In turn, we always keep our share value at $1,000, but you'll own more shares at the end of each year when we complete our values.
Excellent. Thank you again for that, Don. So I have a great, I love the way this investor asked this question, which is if you were recommending to your family member who's not going to be retiring in the next decade, which fund to invest in, which would you recommend, and what are the pros and cons between the different funds?
So it's a great question, and I'm going to assume for this question and that you don't need the income from it. You don't need monthly income, and I assume most of you probably have good income if you're still working. So if you're not looking for income, you're not looking to retire for the next decade plus, I think was how you phrased it. I would 110% be telling you should go into the housing fund. I believe wholeheartedly and strongly that the housing fund will dramatically outperform our lending strategy looking out at a decade plus. Putting aside even the tax efficient nature of it, not knowing if you're talking about qualified or unqualified money, it's still going to very likely outperform our lending strategy. And there's a great probability we generate, mid-teen, even could be high teen level annual returns, which over a long period of time, over a decade, that makes a tremendous difference than generating 11, 12%, and then if you take in, if this is taxable money, it's an even more dramatic of a difference. So in short, that's what I would be telling you. And I can tell you for myself and for my family, we're heavily weighted in our real estate equity side of our portfolio. We invest in our own lending strategy just like you do, and constantly, increasing our allocation there because it does provide great liquidity and great current income. But for myself, I don't need current income and from my investments. So I'm looking at the best long-term growth, and I am very much tax sensitive. So for me, it's heavily on the housing fund side, and that's what I'd advise. My mother, brother, and my brother is invested in that strategy, and anybody else close, if that's how you're looking at it. If you're looking for income on a current basis, that's where it starts becoming a little bit more of an evaluation. Housing fund produces a 6% or 0.5% dividend every month, but the lending side produces nearly a 1% dividend every single month. So that would be the other factor to consider if you are looking for income.
Excellent. Perfect. Thank you very much. And while sticking with the housing fund, just a quick question. I know the answer, but I'll let you take it away. Do you use or have any opportunity zones in the funds?
Yeah, it's a great question. So, so a quick note for those who don't know what opportunity zone is. Opportunity zone came out a few years ago, and it was a kind of government focus to get people to invest money, start businesses, develop, real estate in the areas of the country that generally don't get development and focus. And believe it or not, about half of America geographically is in an opportunity zone, but it's not the good half generally in terms of where you'd want to invest your money. And so there are great opportunities where, if you can invest in I'll call the path of progress, or kind of on the fringe of something that's in an opportunity zone and not, there's some great opportunities, some who've done a great job of that. And it only works though for, projects where you're going to invest more in physical improvements than the original basis. So it doesn't work for value adds. You have to spend more on improvements than what your original basis was. So since we don't do a lot of full development projects in the funds, it generally doesn't work for us. But we've looked at many opportunity zones. We evaluate them. They have to be able to stand on their own. They have to be a great investment outside of being an opportunity zone. And then if it does meet those criteria, we would do it. So oddly enough, and this, as whoever asked this question didn't know this, we actually just bought a property on Friday, which was an old movie theater in our hometown of Bethlehem, Pennsylvania, that we're actually going to build into a 14-story high-rise apartment building. And that actually is an opportunity zone. So we're debating if we're going to set up an opportunity zone fund to help investors such as maybe yourself, where that allows you to, sell that Amazon stock that's increased, tremendously, and be able to do so with a way to be able to defer those and ultimately never pay the taxes on those gains. And, I won't get too deep into that, but so potentially we will in the future, but today we don't, is the shorter answer to the question.
Excellent. So I'm going to ask a few more questions that have come through, and then I'd love to, Jim, ask you a question or two, and then allow you to ask questions, any you might have for Don, myself. So with that said, quick one, Don, how can an investor perform due diligence if they want to get involved in the fund?
So first thing I'd say is, usually one of two or three of these items will happen. People do diligence. One is, talking with one of my associates, Rich or Larry or Bob or Mike or Brad, any of our members, our investment team, having a conversation with them, getting to know us, getting to understand us, getting us to understand you, and talk through and get a better understanding of the investment. So that's certainly a piece to the puzzle. Some like to, as the next step before they do that, go to our investor portal, dlpinvest.com, and go, or you can go to dlpcapitalpartners.com, which is our main website, dlpcapitalpartners.com, and look through our website, look at our funds. But when you go to our investor portal, and if you just send us an email or fill out your information or provide it to Rich now in the chat box, if you drop your email address into him, we'll set you up with a login into our investor portal, and that'll allow you to see, again, our audits, our fund documents, all the financials, all the actual loans, all the properties we own, all the kind of information you could want to see. And then, the kind of third piece to all that is, getting some third party, validation is something that you might, if you're interested in, we can provide as well. So certainly you have some here from Jim, who's an investor with us and on with us now, who you guys, of course, all know and trust. And we now are proud to say we already now have many white coat investors as investors, and we could have you talk to many of those. I'm sure there's probably some of that discussion already going in within amongst the network, and you can see who other people investing with us, but we can put you in touch with other members. And then we're happy to put you in touch with references of longstanding DLP investors that you can talk to. You can come to one of our live events or virtual events, which we'll send you information on, and talk to other existing investors and learn from them and hear their experience. So in short, we're very, very transparent, lots of ways to get to know us, hear from us, hear from others, and conduct your own due diligence as well.
Excellent. Appreciate that, Don. And then in general, just for white coat investors, the minimum is 100,000. Some investors would like to know, is that a minimum into just one fund, or can they split that amongst funds?
That's a good question. So I guess we'd be open to in short, I'll make the decision on the spot here. I haven't really thought about it, but that we would be willing to let you break it apart. Generally, our minimum is 250 per fund. We already made kind of the decision to lower that to make this more widely open to white coat investors building relationships with us. So if you said, hey, I want to put 50 grand or 75 grand in a housing fund and do the same thing in the lending fund as an example, we can accommodate that.
Excellent. Appreciate that. And just so everyone knows, we are well now in the last week and a half that we've been working with white coat investors. We've taken on over 100 investors already that have come through, many of them making commitments already, well over 5 million that has come through. So a lot of positive progress.
Thank you to all of you.
Yes. Thank you for those of you who've already invested. And since you might not have heard, Don mentioned all those websites, Jim made it very easy, right? There's a white coat page that you can go to, just www.whitecoatinvestor.com/DLP. So very simple to get, to fill out a form, get to the landing page, and we'll be quick to return your call and make sure that we help you get through the due diligence. And then with that, Jim, turning to you, maybe if you can just tell us and tell the investors out there what attracted you to DLP and why did you decide to invest in the DLP funds?
Sure. Just a few things, just bookkeeping wise. I'm not sure anybody's mentioned on here. Most of the people in the Facebook group are accredited investors, but I know that not quite all of them are. There are some residents in there. There are some non-physicians there that don't necessarily qualify. Remember, to invest in these, you have to be an accredited investor. So it's an income of $200,000 a year or $300,000 with your spouse, or investable assets of $1 million or more. So hard requirement there. It's a government requirement. It's interesting that since it's not indexed to inflation, that requirement has actually gone down over the years, and it's a lot easier to meet that requirement than it used to be. But one of the things that really attracted me to DLP was the fund structure's fee structure. Mostly because it was something I hadn't seen before. Over the last 4 or 5 years, I've looked at I don't know how many funds and individual syndications, and routinely the fee gets paid before the preferred return is paid out. Now, not the promote, but the actual fee. And I thought that was really unique with DLP, that you get your preferred return before they get paid anything. So do you want to say anything about that, Don, why you chose to make that decision, or why you made that decision to charge that way?
Yeah, Jim, I'd love to. And we've say, here a lot, we've been saying it from the first day we started taking investor capital. Our principles, our rules to investing is, number one, never, ever, ever, ever lose investor money. Rule 2 is generate consistent returns. And then rule 3 is, to generate best returns we can without sacrificing rules 1 and 2. And in most cases, that means, as you guys just saw, a double-digit return. So, no losses, double-digit returns with monthly distributions. That's essentially been our formula of success for these past, decade, and what investors have come to know and expect from us. But as we, set out years ago, we realized it was really, really critical that we're putting investors first, and we're making sure that we're backing up those principles and those guidance by our actions and how we structure our funds. So setting what most would consider pretty good, high preferred return hurdles to start with was a good first step in that direction. But then making sure that we're paying those preferred returns out before we earn anything is a further way of us making sure we're always putting investors first, and they're getting the first cash flow that comes in. And we're blessed both from the investment strategies we've chosen, and our ability to execute through some turbulence, that we've never been in a situation where we've ever missed a preferred return. But if we ever did, we would have to defer our management fee. And the structure is even better than it might sound, because our preferred return structure is on a cumulative basis, meaning if, hey, in our lending fund this month, we missed our 10% target or hurdle and we only distributed 8. Well, next month I need to get you the 10, plus I need to get you what I didn't get you last month before I can get a management fee, let alone any profit. So it's a really pro investor structure that we're proud to be able to offer.
Yeah, so the attraction to me of the funds are primarily twofold. One, very low correlation with the rest of my portfolio, and 2, high returns, right? That's exactly what you're looking for in any asset class. One thing I think people worry about, it hasn't been that long since 2008, when there was a major real estate meltdown all over the country. Can you talk about what performance might look like in both the housing fund and in the lending fund in a 2008-like scenario?
Love to. And this is when I get that question in some different ways, it's a big question that I could spend hours talking about. But before I give a specific answer, I want to highlight something. I don't some of you on live here with us, or watch this later, this may be our first time interacting. And when I say what I'm about to say, I want to make sure I'm not saying this with any feeling of any position of hubris that bad things can't happen or won't happen. We all just learned and went through some pretty crazy event this past year. But I always do like to remind people that this market environment is dramatically different than 2006, 7, 8, what led to the 2008 meltdown. And what I mean by that, when it comes to housing, which is virtually all we invest in, we had the greatest oversupply of housing in American history in 2008. Today, we have the greatest undersupply of housing in American history. That might not sound like that big of a deal, but that is a tremendously, starkly different situation that we're in today than we were in there. Real estate, like most things, it's about supply and demand. And we have a dramatic undersupply of housing, especially when we're talking about workforce affordable housing in America today, greater undersupply than there's ever been. And that's growing every single day. So that creates a very nice, cushion, safety net or valve to the market that didn't exist. It was a very different situation in the last cycle. But a couple comments. One, I'd say, in our housing side, our equity side, important thing to mention that if we had a credible recessionary environment and real estate values drop tremendously and there's illiquidity in the capital markets, what I believe confidently in is that we will be able to continue to achieve and collect rents. We will continue to have very high occupancy, and we will continue to be able to generate great, consistent cash flow. As I talked a little bit about earlier, they aren't making more $900 a month apartments in any of the markets we're in. And when we're in a recessionary environment, and we saw this in COVID, every single month since COVID started, we broke new all-time high occupancies. So in the depths of unemployment skyrocketing and all this nervousness and all this fear and all this noise, every month our occupancy kept going up, and we had zero pressure on rents. So more people are going to go from Class A $1,500 a month apartments into $900, $800, $1,000 apartments when you're in a recessionary environment. So there's a lot of reasons why if we were in a 2008 environment, it would actually benefit us. And in the 2008 environment, even with the greatest oversupply of real estate, this asset class of workforce housing maintained flat rents and increased occupancies in most markets across the country. So, but what we could potentially run into is an environment of illiquidity where we aren't able to provide redemptions if we were in the depths of a recession environment. But the honest truth is you don't want to take your money out of an investment producing great cash flow and us to sell or exit assets at drastically reduced prices because we're in a 12 to 24 month low point before markets recover, which is all that it generally lasts in the housing market. So that's first point I'll mention. On the lending side of our business, it's a similar story that we're lending to investors who are buying distressed real estate. Well, when we're in a recessionary environment like 2008, guess what? There's a lot more distressed real estate. And the very best operators, the very best borrowers are not going to stop buying. They're going to be buying more. We built our portfolio. I built my family's wealth initially on flipping homes in the downturn of the market, investing in buying heavily distressed assets. We bought all kinds of heavily distressed assets from 2007 through 2012 when the markets were at their bottom. We were buying all through that environment as well as many other great investors were doing. And there's going to be a lot of this opportunity. So we as a lender are able to lend to the very best operators who are buying at lower basis. We're going to have less competition from other lenders, which means we're going to be able to get higher rates, be at lower leverage against lower value pricing to the very best operators. So we believe we'll be able to continue to lend and continue to generate great returns as there'll be a lot of activity and need for our type of capital in that environment. But again, similar story to the equity side in that liquidity could potentially become the challenge if in that kind of doomsday scenario. But important point, I think that I always come back to on our lending strategy, if all of our borrowers stop making payments tomorrow and all of our borrowers we had to take them into foreclosure, either they handed us the keys or we had to go all the way to sheriff's sale and we had to take back all of the properties we have loans against. First of all, we could do that from a management standpoint as we own and manage the same type of properties in the same markets right now. So we have the capability to do it. But if we did that, we would take back our portfolio at about a 13% cap rate, which means with no leverage, we'd be at a 13% cash on cash return. So the fact that we're making loans against workforce housing that can easily be rented and generate great cash flow, and we'd be taking back these properties at drastically discounted prices because our average loan to value is 55%, we wouldn't be in the worst position. Again, liquidity could be a challenge. But our ability to continue to generate great cash flow and weather tough times, we think we'll be in an excellent position.
Awesome. Now, a lot of people might not understand exactly how a real estate lending fund makes money. They look at mortgages and they go, "My mortgage is 2.5%. How in the world am I getting 10% returns out of this?" And essentially, it comes from the fact that these developers, these operators, are willing to pay points and a pretty high interest rate in order to not deal with a bank, essentially, for a 9-month loan or something like that. Now, a lot of people wonder, well, why in the world would I want to lend money to somebody that a bank wouldn't want to lend money to? Can you explain a little bit about that?
Love to. Yeah, great perspective there. So I would first start saying that we absolutely are not lending to borrowers who a bank does not want to lend to. Most of our borrowers, if not, I'll stick with most. I won't say everyone, but 99% of our borrowers, I would categorize are bankable, meaning the banks would gladly lend to them on stable properties for long-term mortgages. If the borrower has, 2 to 3 months to go through the lending process, because that's what it takes to get a loan from a bank today. It's a slow and arduous process, but they want to lend on stable income producing properties. And over 60% of our loans we make, the borrower takes our loan, pays our loan off through permanent financing with banks, with agency lenders, government-backed lenders, et cetera. So most of our borrowers are using the super cheap financing we all know is out there for their permanent financing. They're using our loans for the short term, on average, as you said, Jim, around 9 months from to buy the property. They generally are closing quickly, 2 to 4 weeks, for us to come in there, work with them quickly, give them capital to purchase the property, to improve the property, and be additive to the process. And we make it very easy to work with, as easy as it can be to any lender, to give your tax returns and your pay stubs and your bank statements and your track record, and get your credit pulled and your background pulled, and answer questions and get an appraisal done. And we do all those things, but we do so with a smile on our face and understanding how being on the other side of the table, being borrowers and working with lenders, making it as enjoyable of a process can be, and then focusing on adding value to them through the construction process, through helping provide them with resources and education and trainings and knowledge. And we host big live events where we bring them to and mastermind and workshop. We're constantly trying to add value to them, helping them grow their business, helping them improve what they're doing, and everything that our borrowers are looking to do. Generally, we've already done and are doing at a larger scale. So we can be a great resource to them. So that, again, they're coming to us for that short-term money to purchase. And at the end of the day, paying us, on average, our interest rate is about 10.2%. So paying us 10.2% plus points and so forth, when it's only on an 8-month loan, 9-month loan, we're talking generally a couple $1,000 difference between what they could potentially save to get a 3% or 4% loan from a bank, if that could get done in time and they deal with the challenges and headache and slowness of it. But they're willing to pay a couple extra $1,000 on a property they're going to make a $40,000 profit on, for the simplicity and confidence that we're going to execute. We're going to be good to work with. We're going to show up. They're not going to lose the property, and we're going to bring value to them throughout the transaction.
Awesome. Well, I think we're coming up to about an hour on this, so we probably ought to cut it off at this point. You can get more information. You can talk to Don and Rich. The easiest way to get more information is to go to whitecoatinvestor.com/DLP. Real easy to remember. And they'll get you in touch. They'll get you certified as an accredited investor, and you can sign the paperwork. It's all done online, and then get your money wired in if you're interested in these investments, either the housing fund, the lending fund, or the notes fund, or the new one we learned about today, which is new to me, the income and growth fund. But all available, and appreciate your time watching the webinar today. This will be available both in the Facebook group as well as on YouTube.
Awesome. Thank you, Jim. Appreciate it. Thanks for all the awesome questions, everybody.
Have a blessed day, all.